October 1845. London Parliament receives applications to build 1,200 miles of new railway lines in a single session. Not a few lines, not dozens, 1,200 miles. By the end of 1846, Parliament will authorize 9,500 miles of new railways. That is enough track to cross Britain 14 times. The entire country is only 600 miles long. Within 2 years, investors will commit over £200 million to railways. That equals 1/3 of Britain's entire GDP. 1/3 of national income bet on a single technology in 2 years. But here is the absurd part. Most of these railways will never be built. The ones that do get built will never make a profit. Investors will lose fortunes. Aristocrats will be ruined. Middle-class families will be destroyed. By 1850, railway shares will trade at less than half their original price. Dividends will collapse from 7% to 2%. The railway king, George Hudson, will be exposed as running a massive fraud, paying dividends from capital instead of profits. He will flee the country to avoid prison. The mania that was supposed to modernize Britain will bankrupt it instead. But here is what makes this different. Railways were real. They worked. They transformed transportation. This was not tulips or South Sea Company fantasies. Railways actually revolutionized the economy, and yet speculation in railway shares created one of history's most devastating bubbles anyway. You can have a real innovation and still destroy wealth through irrational speculation. How did Britain's railway revolution turn into a financial catastrophe? And why are we watching the exact same pattern unfold right now with AI stocks? This is the story of railway mania. By the end, you will understand the 7 steps that turn genuine innovation into destructive speculation. See how transformative technology can still create bubbles, and recognize the warning signs flashing in tech stocks today. This is not just history. This is a warning. It is 1830, Liverpool to Manchester. The smell of coal smoke fills the air as George Stephenson's rocket pulls the first passenger train in history. Crowds gather to watch the miracle of steam locomotion. The train travels at 30 miles per hour, faster than any human has ever moved on land. This is not incremental improvement. This is revolutionary. Before railways, traveling from London to Manchester took 2 days by stagecoach. The train does it in 5 hours. Before railways, shipping goods required canals or horse-drawn wagons. Expensive, slow, limited. Railways can carry 10 times the cargo at half the cost in a quarter of the time. This is the future arriving. In this world, Britain dominates global trade. The Industrial Revolution is transforming the economy. Factories multiply, cities grow. Coal production doubles every 20 years, but transportation is the bottleneck. Canals served well for decades, but they freeze in winter, flood in spring, and cannot climb hills. Roads are terrible, turnpikes charge tolls, stagecoaches are uncomfortable and dangerous. The economy needs better transport. Railways are the solution everyone has been waiting for. To most investors, railway shares seem like guaranteed profits. Britain is building the infrastructure of the future. Railways will carry passengers and freight forever. Dividends will flow for generations. This is not speculation. This is investment in proven technology with obvious demand. The logic is bulletproof, and it is exactly wrong. Meet George Hudson. He is a draper's assistant from York. In 1827, he inherits £30,000 from a distant relative. A fortune for a working man. He invests in the York and North Midland Railway. Becomes chairman in 1833. Over the next decade, Hudson builds a railway empire. By 1844, he controls over 1,000 miles of track, 1/4 of Britain's entire railway network. They call him the Railway King. He lives like royalty. Mansion in London, country estate, entertains the Prime Minister. George Hudson embodies the promise of railways. A common man made rich through vision and railways. Everyone wants to be Hudson. Everyone wants to invest in his companies. But there is James Morrison. He is a merchant and member of Parliament. He watches railway speculation accelerating in 1845. He sees ordinary people mortgaging homes to buy railway shares. He notices that proposed railways make no economic sense. Lines planned to run parallel to existing lines. Railways to nowhere. He warns that this is speculation detached from fundamentals. He tells anyone who will listen that most of these railways will never pay dividends. Nobody listens. Morrison is dismissed as old-fashioned. He does not understand the new economy. Railways are different. This time is different. And there is John Sadler. He is an Irish banker and politician. He understands exactly what is happening. Railway mania is a bubble, but bubbles create opportunities. Sadler promotes dubious railway schemes, sells shares to the public, pockets the proceeds. He knows these railways will fail. He does not care. He will be rich long before the crash. This is fraud disguised as entrepreneurship, and it is perfectly legal. What none of them know yet is that they are creating the largest speculative bubble Britain has ever seen. The pattern forming in 1844 will climax in 1846 and crash by 1850. 1844. The spark ignites. The government passes the Railway Regulation Act. It allows easier formation of railway companies. Suddenly, starting a railway becomes simple. File paperwork, get parliamentary approval, issue shares, raise capital, build track, or not. The regulatory change opens floodgates. Promoters realize you can get rich from promoting railways without ever laying a mile of track. Just get parliamentary approval, issue shares, pay yourself fees and salaries. If the railway fails, blame bad luck. If it succeeds, take credit. The incentives are completely wrong. Railway promotion becomes an industry. Lawyers draft prospectuses, surveyors plan routes, engineers estimate costs, all charging fees. Whether the railway makes sense economically does not matter. What matters is getting parliamentary approval and selling shares to the public. By 1845, hundreds of new railway schemes flood Parliament. Some are legitimate, most are not. The Great Direct Northern Railway proposes a direct line from London to York. Sounds good, except there is already a railway on that route. The new line would compete directly with the existing one. Neither would make a profit. The Eastern Counties and Thames Junction Railway proposes connecting to lines that are 8 miles apart. The engineering makes no sense. The economics are worse, but the shares sell anyway. At first, early investors make real money. Legitimate railways, like the London and Birmingham line, pay 10% dividends. The Great Western Railway pays 7%. These are solid returns. Investors who bought shares in 1838 have doubled their money by 1844. This creates the FOMO dynamic. Everyone knows someone who got rich from railways. Your neighbor, your cousin, your colleague. They bought shares. They made profits. Why are you not doing the same? The social proof is overwhelming. By 1845, railway investment becomes a national obsession. Newspapers publish railway share prices daily. Coffee houses buzz with railway gossip. Strangers discuss railway shares on street corners. Clergymen invest church funds in railways. Widows invest life savings. Aristocrats mortgage estates. The mania crosses all social classes. Then it accelerates beyond anyone's control. In 1844, Parliament authorizes 805 miles of new railway. That seems like a lot. But in 1845, Parliament receives applications for 3,000 miles. By October 1845, the applications reach 1,200 miles in a single parliamentary session. By the end of 1846, Parliament will pass 263 railway acts, authorizing 9,500 miles of track. This is insanity. Britain has 2,200 miles of existing railway in 1845. Parliament just authorized building for times that amount in 2 years. The country does not need 9,500 new miles. The traffic does not exist. The capital does not exist. The workers do not exist. The iron does not exist. But the speculation exists. Prices are no longer based on fundamentals. They are based on momentum. A railway company announces formation. Shares are offered at £100. Within days they trade at £150. Then 200. Then 250. Investors are not buying railways. They are buying lottery tickets, hoping to sell higher before the crash. This is the greater fool theory in action. I know this share is overvalued, but I will find a greater fool to buy it from me at an even higher price. And for a while, it works. The share deposit system makes speculation easy and dangerous. You do not need to pay full price for railway shares. You pay a small deposit, usually 10%. The railway will call the rest over time as they need money for construction. This is leverage. For £10, you control a £100 share. If it goes to 150, you made £50 profit on a £10 investment. That is 500% return. Who can resist? But if it falls to 50, you still owe £90 to the company. You have unlimited downside on a £10 bet. Most investors do not understand this. They think they are risking £10. They are actually on the hook for 100. By mid-1846, anyone who questions railway mania is shouted down. The believers have an answer for everything. Railways are the future. Britain is becoming a railway economy. International investors are buying British railway shares. The government supports railways. Engineers endorse them. Even Queen Victoria rides trains. How can this be a bubble when the technology is real and the government backs it? The skeptics are dismissed as Luddites. People afraid of progress, stuck in the past. Railway shares only go up. Until they do not. October 1845. This is the peak moment. The Railway Times publishes a list of proposed railways. The total capital required is £700 million. That is 3 times Britain's GDP, 3 times the entire annual output of the economy. Obviously impossible, but nobody cares. In October 1845, railway shares reached their highest prices. Shares that cost £100 in 1843 now trade at 220. The Eastern Counties Railway, a company that will later become notorious for fraud, sees its shares double in months. George Hudson's York and North Midland Railway trades at huge premiums. This is the top, nobody knows it yet. The trigger comes from an unexpected direction. The Bank of England raises interest rates in October 1845, from 2.5% to 3%, then to 3.5% in January 1846. Why? Because gold is flowing out of Britain, the government needs to defend the gold standard. Higher rates attract capital back, but higher rates make borrowing expensive. Railway companies borrow heavily to finance construction. When rates rise, projects that looked profitable become marginal. Marginal projects become unprofitable. Investors start calculating the actual returns on these railways. The numbers do not work. At first, people think it is temporary, just a correction. Railway shares fall 10%, then 20%. Investors who bought on leverage get margin calls. The railway companies demand the next installment of share capital. Investors must pay £20 per share, but the shares now trade below their original price. People are paying £20 for shares worth £15, then paying another £20 for shares worth £10. The leverage works in reverse. Within months, panic sets in. By 1847, railway share prices have fallen 40% from the 1845 peak. But the real devastation is just beginning. Most railways are only partially built. They need more capital to finish construction. The share calls keep coming. Investors who thought they risked £10 discover they owe £50, £60, £70. Some railways were authorized but never started. Those shares become worthless immediately. Other railways are half-built. They cannot operate until complete. They generate no revenue, pay no dividends, but demand more capital. Investors are trapped, pay more money into a failing railway or lose everything already invested. Most choose to pay, throwing good money after bad. By 1850 the devastation is complete. Railway shares that traded at £200 in 1845 now trade at £80, a 60% loss. But that is just the share price. Investors also paid multiple share calls. Total losses exceed 70 or 80% for many. Dividends collapse from 7% on average in 1845 to 2% by 1850. Railways that promise 10% returns deliver nothing. Meet Thomas Brassey. He is a railway contractor. He built hundreds of miles of track. He employs 80,000 men at the peak. When railway companies cannot pay him, he takes shares as payment. By 1850, those shares are worthless. Brassey survives because he diversified. He built railways in France, Italy, Canada, and India. The British mania destroyed many. Brassey's international work saved him, but thousands of smaller contractors go bankrupt. They have no international business, just British railway debt they cannot collect. Meet Sarah Clark. She is a widow living in Bath. Her late husband left her £2,000, a comfortable sum for a modest life. Her solicitor invested it in railway shares, diversified across multiple companies. Eastern Counties, Direct Northern Thames, Junction, all seemed safe in 1845. By 1850, the shares are worth £600. She lost 70%. Worse, the railways keep calling for more capital. She owes another £800 in unpaid share calls. She does not have it. She must sell her home to pay the railway companies for the privilege of losing her money. She ends up in poverty. Her story is repeated thousands of times across Britain, but George Hudson escapes. For a while, in 1849, an audit of his railway companies reveals fraud. Hudson paid dividends from capital, not profits. He used money from new investors to pay old investors. A classic Ponzi scheme. He bought land from himself at inflated prices. He falsified accounts. When exposed, Hudson resigns all chairmanships. His reputation is destroyed. He flees to France to avoid creditors and possible prosecution. The railway king dies in poverty in 1871. But he lived well for 15 years on other people's money. The investors who trusted him lose everything. The courts flood with lawsuits. Shareholders sue railway companies, contractors sue for unpaid bills. Landowners sue over property seized for railways never built. Thousands of cases clog the courts for years. Parliament investigates. They find widespread fraud, misrepresentation, and incompetence. They pass new regulations, require audits, mandate disclosure, create legal liability for directors. But the reforms come too late. The money is gone. By 1850, over £200 million has been invested in railways. About 1/3 of it was wasted on railways that failed or were never built. That is £60 to £70 million destroyed, transferred from investors to promoters, lawyers, and fraudsters. The human cost is staggering. Thousands of families ruined, life savings evaporated, retirements destroyed, trust in markets shattered for a generation. So what really happened? History books say railway mania was irrational exuberance over a new technology. Investors got excited, lost their heads, made bad decisions. But that is not just incomplete. It misses the deeper mechanism. Here is what actually happened. Railway mania was caused by a deadly combination of genuine innovation, easy leverage, and misaligned incentives. Railways were real and transformative. That made the speculation seem rational. The deposit system created leverage that amplified gains and losses. The promotion system rewarded getting parliamentary approval, not building profitable railways. Let me break this down. Railways were genuinely revolutionary. They cut transport costs by 80%, reduced travel time by 75%. This was not hype. This was real. So investing in railways seemed smart. But not all railways make sense. A railway from London to Manchester is brilliant. A railway parallel to the existing London to Manchester line is stupid. Both got funded in the mania. The second railway from London to Birmingham competed with the first. Neither made adequate profits. The market funded indiscriminately. Good railways and bad railways both sold shares at inflated prices. Think of it like this. Imagine someone invents a miracle drug that cures cancer, revolutionary, life-saving, obviously valuable. Now imagine 100 companies claim to have similar drugs. Most are fake, some are real but inferior, a few are legitimate competitors. In a mania, investors buy shares in all 100 companies. They cannot tell the difference between the real drug and the fakes. They just know cancer drugs are the future. That is railway mania. Railways were the miracle drug. But most of the railway schemes were fakes or unnecessary duplicates. But here is what nobody talks about. The real profiteers were not the investors. The real winners were the promoters. Railway promotion was a business. Promoters would identify a potential route, form a company, hire lawyers, surveyors, and engineers to create a prospectus, get parliamentary approval, issue shares, take fees at every step, promotion fees, legal fees, survey fees, engineering fees, parliamentary fees. By the time shares were sold, the promoters had extracted 10 to 20% of the capital. Whether the railway succeeded or failed, they got paid. This created a flood of promotions. Between 1844 and 1846, over 1,200 railway schemes were proposed. Most were promoted for fees, not built for profits. Now let me show you the pattern. This is the technology bubble formula. It happens every time. First, genuine innovation. A transformative technology emerges. Railways, electricity, internet, AI. The technology is real. The revolution is real. This creates legitimate excitement. Second, easy capital access. Financial innovation makes investing easy. The railway deposit system allowed 10x leverage. The dot-com era had online brokerages. Today we have zero-fee trading apps. Access is democratized. Everyone can invest. Third, promotion industry emerges. Middlemen profit from capital formation, not business success. Railway promoters, dot-com investment banks, SPAC sponsors today. They get rich bringing deals to market. Whether the deals succeed is someone else's problem. Fourth, indiscriminate funding. Investors cannot distinguish good companies from bad. All technology companies get funded. Quality is irrelevant. Only the narrative matters. Railways to nowhere get funded alongside sensible routes. Fifth, leverage amplifies. The deposit system in railways. Margin lending in 1929. Dot-com margin. Options today. Leverage makes small movements devastating. A 20% decline becomes a 100% loss when leveraged 5x. Sixth, regulatory approval as signal. Parliamentary approval meant a railway was legitimate. IPO meant a dot-com was real. Being publicly traded signals quality, but approval does not guarantee profits. Lots of approved railways failed. Seventh, extended collapse. Technology bubbles do not crash in a day. They bleed for years. Railway shares fell from 1846 to 1850. 4 years of grinding losses. .com took 3 years. The extended timeline gives false hope, creates dead cat bounces, traps investors who think they are buying the dip. This pattern repeated in electricity in the 1920s. .com in the 1990s. Clean tech in the 2000s. Now it is repeating in. Now let us talk about 2024 and 2025. Right now AI stocks are experiencing railway mania dynamics. Nvidia's market cap hit $3.3 trillion in 2024. That is more than the GDP of France. For a company that makes chips, the chips are revolutionary. AI is real. But is one chip company worth more than the entire French economy? AI-related stocks have attracted over $1 trillion in investments since ChatGPT launched in late 2022. Hundreds of AI startups get funded at billion-dollar valuations. Most have no revenue. Some have no product, just a pitch deck and the word AI sound familiar. Let us run through the checklist. Genuine innovation. Check. AI is transformative. ChatGPT Dolly. These are revolutionary breakthroughs. AI will change everything, just like railways changed everything. The technology is real. Easy capital access. Check. Zero-fee brokerages. Fractional shares. Options trading on apps. Retail investors pour billions into AI stocks. Everyone can buy Nvidia on their phone. Access is universal. Promotion industry. Check. AI startups raise money at absurd valuations. Founders take fees. Venture capitalists take fees. Investment banks take IPO fees. SPACs take sponsor fees. The promotion industry is massive. Whether these companies succeed is uncertain. Whether the promoters get paid is guaranteed. Indiscriminate funding. Check. Any company adding AI to its name sees its stock jump. AI washing is rampant. Companies rebrand as AI companies to attract capital. The market cannot distinguish real AI companies from fakes. Everything gets funded. Leverage. Partial check. Retail investors use options and margin, not 10x leverage like railway deposits, but 2x to 5x is common, enough to amplify losses when the bubble pops. Regulatory approval as signal. Check. Being a publicly traded AI company signals legitimacy. IPO means the company is real, but profitability is uncertain. Many AI companies burn billions. No path to profitability, yet they trade at 20x revenue. Now, is this exactly like railway mania? No. We have better information, better regulations, better understanding of bubbles. AI companies disclose financials. Railway companies often did not. We have the SEC. Britain had parliament but minimal oversight. These differences matter, but the fundamentals are eerily similar. Transformative technology. Check. Indiscriminate funding. Check. Leverage. Check. Promoter. Profits. Check. Investor mania. Check. The pattern fits. What is different? The scale. Railway mania sucked in 1/3 of Britain's GDP. AI has attracted over $1 trillion globally, but global GDP is 100 trillion. So it is only 1%, much smaller relative to the economy. For now, the speed. Railway mania took 5 years from 1843 to 1848. AI mania has been running for 2 years since late 2022. Modern markets move faster. Information spreads instantly. Capital flows electronically. The timeline compresses. What should you watch for? First, profitability. Most railway companies never made money. If AI companies cannot show a path to profitability, they are speculative. Nvidia makes huge profits. That is real. But most AI startups burn cash. When capital markets tighten, unprofitable companies fail. Second, competition. Railway mania funded competing lines on the same routes. All failed. If 10 companies compete in the same AI niche, most will fail. Funding multiple competitors is wasteful. Someone will win, most will lose. Third, capital calls. Railway investors thought they risked £10. They owed 100. Modern equivalents are margin calls, option expiration, forced liquidation. If you use leverage, understand your maximum loss. It is not your initial investment, it is your total obligation. Fourth, promoter behavior. Are insiders selling? Are early investors cashing out? Railway promoters sold at the peak. Left retail investors holding the bag. If AI company insiders are selling, that is a warning sign. I am not predicting AI stocks will crash tomorrow. I am showing you the pattern. The pattern from railway mania. Genuine innovation. Indiscriminate funding. Leverage. Promoter profits. Investor mania. Extended collapse. The question is whether we are in 1844 or 1846, the beginning or the end. So why do we keep falling for this? Because technology bubbles are not market failures. They are features of how humans respond to genuine innovation. We are wired to extrapolate. Railways changed everything, so we assume all railways will make money. AI changes everything, so we assume all AI companies will make money. Linear thinking in a non-linear world. Investors are wired to chase returns. Early railway investors doubled their money. Early AI investors made fortunes. FOMO is biological. We evolved to copy successful behavior. If your neighbor got rich, you copy them. This worked for finding food. It fails in speculative markets. Promoters are wired to extract fees. Railway promoters made fortunes whether railways succeeded or failed. Modern venture capitalists and investment bankers do the same. Take fees up front. Let investors bear the risk. This is rational for promoters, devastating for investors. Regulators are wired to allow innovation. Parliament approved 9,500 miles of railway. Too much, but politicians wanted to support progress. Modern regulators allow AI companies to operate with minimal oversight. They do not want to stifle innovation. The bias is toward permission, not protection. But here is what this story really teaches us. The disaster is not the crash. The disaster is the wasted capital. Britain invested £200 million in railways. 1/3 was wasted on railways that failed or were never built. That is £60 million that could have built schools, hospitals, roads, or productive businesses. Instead, it was transferred to promoters and fraudsters. The opportunity cost is staggering. Railway mania did not destroy the railway industry. By 1850, Britain had the best railway network in the world. Railways transformed the economy, created wealth, enabled growth. But most investors lost money. The technology succeeded. The speculation failed. Those are not contradictory. You can have revolutionary technology and a devastating bubble simultaneously. The technology creates real value. The speculation destroys wealth. AI will likely follow the same path. AI will transform the economy, create wealth, change industries. But most AI investors will lose money. Most AI companies will fail. The technology will succeed while the speculation collapses. That is the lesson of railway mania. Innovation and speculation are different. Confusing them is expensive. Understanding this does not give you a crystal ball. Railway mania peaked in 1845. The crash took 5 years. AI might peak in 2025, or 2027, or not at all if it is not a bubble. Timing is impossible. But pattern recognition is priceless. When you see transformative technology, that is real. When you see indiscriminate funding of anything related to that technology, that is speculation. When you see leverage making small bets into big risks, that is danger. When you see promoters getting rich while investors wait for returns, that is extraction. These patterns are timeless. You cannot control whether AI is a bubble. You cannot prevent speculation. You cannot stop promoters from promoting. But you can control your own decisions. You can invest in profitable companies instead of speculative ones. You can avoid leverage. You can distinguish innovation from speculation. You can learn from 1845. The British who survived railway mania were not the ones who bought every railway share. They were the ones who invested in the proven companies. The London and Birmingham Railway, the Great Western Railway, companies with traffic, revenue, profits, dividends. Those investments did fine. The speculation in railways to nowhere destroyed wealth. The investors who will survive AI will not be the ones buying every AI stock. They will be the ones investing in companies with sustainable competitive advantages, real customers, actual profits, proven business models. Those companies will do fine. The speculation in AI wrappers will destroy wealth. That lesson is 180 years old. It is timeless. Now I want to hear from you. Do you see railway mania patterns in AI stocks? Which AI companies are real and which are speculation? What am I missing? Drop your thoughts in the comments. The best analysis often comes from you, not me. If this changed how you see technology bubbles, hit that like button. Subscribe if you want more economic history that actually matters. Next time, we are diving into the dot-com bubble. When the internet was going to change everything, it did. But investors still lost trillions. Another pattern hiding in plain sight. Another lesson they do not teach in school. Remember, history does not repeat, but it rhymes. And right now, AI stocks are rhyming with railway mania. See you in the next one.